We recently had a thought-provoking conversation with Richard Heft, president and co-founder at EXT Marketing in Toronto. We absolutely love talking to Richard as he has a uniquely qualified perspective on the entire Canadian investment industry as one of the heads of what is arguably one of the best institutional communications consulting and production teams on both sides of the border. Along with EXT's co-founder, Jillian Bannister, Richard leads a group of communications and marketing experts working with North America's largest financial institutions. Hello and welcome to this special episode of Insight is Capital. Thank you very much for listening. Richard and his team talk to just about everyone in the business about what's going on and all of the thought leadership that's occurring across the investment company ecosystem, and have a bird's eye view of all that is happening, all of the opinions that are floating around from all sides of the investment business. Please enjoy our conversation and interview. This is part one.
This is the Insight is Capital podcast.
The views and opinions expressed in this broadcast are those of the individual guests and do not necessarily reflect the official policy or position of AdvisorAnalyst.com or of our guests. This broadcast is meant to be for informational purposes only. Nothing discussed in this broadcast is intended to be considered as advice.
So how have you been?
Been a crazy year. You can't say otherwise, right? It's there's a lot going on out there, a lot of uncertainty, and it's I think that 2023 is shaping up to be a very interesting year.
Yeah, by all means, for sure. It's anyone's guess.
It really is anyone's guess. I think we may have a little bit more pain before we start feeling a little better and like we've rounded a corner, but I don't know when that will be. I think we have a little while longer before we hit rock bottom.
Yeah, for sure. I think the Fed seems to be, Jerome Powell at least seems to be sort of hell bent on pursuing this goal of stomping out inflation, and but at the expense of everything else, it seems. So.
Well, I'm not an economist, but it did seem like we were all aware of inflation well before the interest rates started rising and tapering began. And to me, I hate to be an armchair Fed chair, but it does sort of feel to me like probably all the central banks could have moved a little bit earlier when the sides of inflation started to rise. I think they wanted to keep the economy humming by keeping interest rates low, but I think they maybe didn't read the tea leaves early enough. They kept saying it was transitory.
That's right.
It turned out to not be transitory at all. It was just the early innings of the ball game.
I was watching. There was some interesting tweets over the weekend, and what's her name? The ECB chairman. One with the white-haired lady.
That Christine
Lagarde. That's it. Yeah. Christine Lagarde. Thank you. Yeah. People were sort of mocking the fact that she, a year ago, on the weekend, had said, insisted that it was transitory, that, we'll figure it out. We know, we don't see that. It doesn't look like it's going to be, sticky, let's say. And then again at the end of the year, she repeated herself, quite vociferously about, about how this wasn't the case, and interest rates, at least inflation, would subside, and everything's going to be okay, right? But frankly, the thing is that, the other central banks of the world haven't been leading monetary policy for a very long time anyway, and certainly the ECB doesn't have as much power as you would imagine, only because they're juggling all the exchange rates across the European Union. That they're in fact the reason, they're actually a big part of the reason why the US dollar is so strong. And that's because they have these exchange rate mechanisms that require them to belong the US dollar when they make these balancing transactions on their side, because oddly enough, the EU is hedged to not hedged but pegged to the dollar. Yeah, and they have so they have no choice but to follow the Fed when the Fed raises rates, and they have no choice but to buy the dollar in order to reserve to bank whatever reserves they are banking, it requires them to offset with the U.S. dollar, which is weird, and that's been a big part. It's been one of the less parts talked about when it comes to the dollar.
Yeah.
That structurally they have to buy the dollar, and that's part of the reason why the dollar is so strong. There's also, that makes the dollar look really, king dollar, because because it's the safest. It's the best of the worst. It's the best. Yeah. It's the best situation in the worst of times. But anyway,
I think so. I mean, and also, it's hard to, like, for me, and I discuss this quite a bit. It's hard to conflate the inflation in the U.S., which is clearly, tied to supply chain disruptions that occurred late last year, earlier this year, and are still arguably occurring, with what's going on in Europe, which to me is really tied to an energy crisis that.
Right. That's right. Yeah. I mean, I forgot to mention that, but yeah.
Has I don't think you can dismiss the fact that Europe is going into a very cold winter right now, and I think that a lot of what we're seeing over there is an impact in North America, nor is what's going on in North America impacting Europe quite as much. And I think that the two, we may see more of a divergence between the two economies, or the economic regions, as things progress over there and over here.
Does it feel to you like this Nord Stream pipeline sabotage story hasn't really had the impact you think it would have? I feel like something really big is coming and it just hasn't landed yet. This Nord Stream, this pipeline sabotage in the Black Sea, just, it's like no one really wants to make a big deal out of it, but isn't it a big deal?
It is a big deal. And yeah. I was literally, before getting on this call, I had been reading an article about what comes next, and I'm a panicker at the best of times. So I'm reading this going, oh boy, you better batten down the hatches. 2023. Yeah. It could get, terrible.
No kidding. Like they're right now, they're still talking about what happened. They're not talking about what that means. And I feel like, holy shit, that's scary.
Yeah. I'm going to have to put a moratorium on reading these types of Outlook articles, because I do not like what I'm seeing. And again, things can go good or they can go bad. I have no idea. I think that it's so hard. Like, we're at such an inflection point right now in terms of what's going on between Russia and Ukraine, and what's going on with the energy impasse. And again, the struggle between renewable energies, lower humanity's carbon footprint versus what we factually need to survive, especially up here in Canada with these ridiculously cold winters. We're not in warmer climes where a tapering of our energy supplies may not impact us quite as bad. Yeah. But there's a lot of countries that depend on petroleum still, unfortunately, or fortunately, depending on your vantage. But we're not in a place yet where we can sort of forgo all the stuff we're pulling out of the ground.
Yeah, I mean, I read, one thing that has stuck with me was David Einhorn's, David Einhorn from Greenlight, David Einhorn's letter last year, his annual letter to his shareholders, was, he pointed out, I mean, his it's probably one of the most quoted things now, although I haven't heard it from anyone else, but I feel like it should be. And that was that his statement was basically that because of ESG, the world is decarbonizing demand faster than it can decarbonize supply, right? And so that's going to lead to pain when it comes, that's going to lead to pain. And so that was a theme of discussion at a conference last year on a panel where we talked about the unintended consequences of ESG.
Yeah.
And I think that's also a big reason why advisors, Canadian advisors in particular, are sort of ambivalent about ESG, because they feel like ESG, all this pressure to do ESG, is a very forceful way to get them to exclude fossil fuels or uranium or all these different items on the ESG hit list. and so there, we did a podcast with TD, and it was about their ESG strategy, which was based on Morningstar on the Sustainalytics Index, and for their three ETFs, US, Canada, and international, and that I thought made a huge amount of sense because it was so inclusive of energy as opposed to exclusive, and so and it was, I believe it was also inclusive of companies like Cameco as well, which play a large role in uranium production. But there's so many things happening, and I feel like companies have made such a big deal out of ESG, and because they want to appear, I think, to be on side. There's such an angst about being seen to be ESG versus whether or not you even agree with it, and whether or not you agree with the extreme, what's happening at the fringes of ESG, at the extremes or at the tails, and I think the consensus is going to become, that not that, activism is the way of the future, and we should invest as activists to get, get to zero carbon, or to get to all electric by 2035, or, I think what's bound to happen is we're going to find out that it's not possible. I had a conversation earlier today where we were talking about upcoming conference dialogue, and my question at the end of that conversation was that, in all the dystopian, horror thriller films, have you ever seen a Tesla on the road? When the electric grid when there's no electric grid in the future, in like the worst case scenario, the power grid goes down and we're all heating with wood and living in cabins.
Yeah. I mean, the Mad Max movies, which I grew up with and always loved.
Exactly.
About the fight for gasoline to power the machine. So it is funny you did not see any in those Mad Max movies. And I think it's, we've done a lot of work at our company with the on the ESG story. We sort of started learning about it a bunch of years ago in Chicago when it sort of first hit our radars. And it lay dormant, at least in Canada, and even mostly in North America. I mean, Europe's been way ahead of North America, and the US was way ahead of Canada. So we've always been a bit behind the curve on the ESG story, the benefits and all of those things. And it's interesting because when you really drill down onto ESG, which I don't think enough people maybe do when they're talking about ESG, and I can't speak to the advisor challenges in discussing ESG, but I can tell you that, ESG is environmental, social, and governance. It's never been just environmental fun. So there's always this focus on fossil fuels, and, things like uranium and nuclear and these types of things, which are totally, I have kids who talk about the environment all the time. So I get the concern that fossil fuels are causing the planet to heat, if you believe the science. But there were other factors to go into Sustainalytics and other rating services for ESG in terms of the social and governance. And it wasn't historically just about cleaning up the planet. It was also about performance. How do you garner performance based on a company's governance? Right. What they're doing to improve the lives of their employees or the lives of their clients or customers. Social, what do they do? How can they drive better performance by having more quality on boards? Like these types of things are rarely done. It always goes straight to
it always goes
discussion. And the S and the G are dropped off, which I think does a disservice to the story in its entirety. I would love to hear more stories about companies, and you hear about Volkswagen and Volkswagen's history. I can't speak to them today, but a couple of years ago they had the diesel controversy, and people said, "Oh, I can't believe Volkswagen's been doing this," but Volkswagen had a history of poor maybe than some of the other auto companies' governance. So this shouldn't have come as a surprise. And many people who were investing, taking an ESG sort of approach, their signals would have flagged that. It wasn't about the environment. It was about a company that had governance issues back then. I can't speak to the company today and what they've done to remedy issues. And a good investor or a lot of good investors saw that company was being screened because of these governance issues, and again, had nothing to do with the environment. It was that the company wasn't as transparent as it needed to be. And so,
Yeah.
and a good investor underweighted Volkswagen and, would have contributed to performance.
Absolutely, 100%. I think that's I wanted to come up with a new definition for ESG, like using the letters, because so far the best I've come up with is extra securities selection groundwork, right? As a risk, risk management layer. And because I've heard it so many times from money managers that one day we won't even mention ESG; it'll just be part of everything we do, and
Right.
it'll be for granted.
Right.
And I don't think the what I came up with encapsulates ESG, but to me, I think that's what a lot of advisors are doing. They're trying to find a way to think about it that is acceptable to them, rather than taking an activist point of view or making it about all of the, but you're right. I think what you're absolutely right about is that it's not strictly about environmental issues. It is about corporate governance, being good corporate citizens, not cheating, with algorithms and software that change the the emissions results on your engines, for example.
Right.
Yeah. So and that's, I also feel like passive investing has, on another note, I also feel like passive investing has also made a lot of the industry sort of dormant on this one-on-one risk management, it's bottom up stock picking, where you're actually, looking very deeply through a company's business and trying to identify, potential risks and events that could affect the value and the reputation of a company like Volkswagen, for example, where something happens and it has a dire impact on the valuation of the company, even though, they're still one of the largest, if not the largest auto manufacturer in the world. The reputation obviously plays a huge role. So,
Well, it's super. Sorry, I'm sorry to cut you off. It's super
Yeah.
important. Reputation. Like, we know that in let's say 19, I'm going to make some of these numbers up, but it's in and around in the 1970s. It was approximately 75% of a company's valuation was based on the company's backward-looking financials. So last
Right.
quarter was good earnings, good revenue, good R&D spend, all of that type of thing, and your stock price went up. And the opposite, your stock price went down. We know that today, about the same number, approximately 70 to 75% of a company's valuation is based more on brand and other intangibles.
That's right.
And reputation matters. It matters not, to a company's valuation, which is what most investors and portfolio managers and other industry players are. This is what we're paid on. So you have to have these types of screens. You have to have this type of knowledge, and whether it's passive or active or private, public,
Yeah,
whatever it is. ESG is another screen, and portfolio managers and algorithms use different screens. This is just like Sustainalytics is another screen. So you could put that overlay on and pay for it. And, it could drive up MERs, but who cares? Maybe your performance will be better. Maybe more clients will come to you because they do see you as caring about similar values to theirs.
Yeah. There's a lower risk that any of these, any sort of scandal could impact. There's a much greater risk that any scandal could impact your valuation, valuation of any of your holdings at any given moment. And that once a reputational scandal happens in any of the three areas, whether it's something to do with inclusion or diversity on boards, or whether or not you're cheating on something or you're a polluter. I mean, there's so many more dimensions to it, but you're right. So little of it gets actually talked about. It all tends to focus on the E, and very little on the S and the G.
And sadly, we do know the G can impact stock or stock prices. We also know that, like, on the S side, board diversity has been shown to improve company performance.
Yeah.
And nobody, even if you talk about the governance and the environmental, the social, I think study after study that we've seen show that you have 50% women on your board and in your in senior leadership, your company is going to do better. And it doesn't make the news as much, but it has to be ingrained as part of every company's overall corporate planning to make gender diversity a massive part of their corporate psyche, of their corporate action.
Yeah.
Because otherwise, they're also missing another opportunity to build a better brand and a better company.
Yeah, absolutely. I think there's a lot to be said about how diversity on a board, inclusive of having more women on boards. It not only does it improve it brings the female dimension to the board, but it also, I would say, it also improves the conscience of the board, and that's probably a big sort of dimension of board diversity that doesn't get enough bandwidth. And I think our discussion here, Richard, on ESG is going to be food for another article.
Good.
Because I think you brought up you made some really interesting points.
I love this story. I mean,
Yeah.
like I said, Jillian, my business partner and co-founder of EXT, she and I learned a lot about this a bunch of years ago, and I've been super interested. And sadly, it took a pandemic to bring it to the fore, because prior to that, everybody thought ESG, environmental, it's going to hurt performance, and I can't, if a client. The sticking point, sadly, was generally, even if a client said, "Oh, I'm interested in learning more about environmental, social, or governance related funds," most advisors couldn't tell the ESG story back then. I think know more about it today. Or if the advisor were super keen on telling the ESG story, they would start the discussion, and the client would say, "Well, I've heard the performance is bad," and the advisor would say, "Okay, let's move on. But we'll talk about something else," because it wasn't worth the friction point when they were trying to build a client portfolio and their business.
Yeah, I mean, I think if you stick to Milton Friedman's edicts, about corporate, about corporate governance, who are these people to tell us how to run our company or what to do or what we shouldn't do, and profit is everything. Even if it means we aren't good corporate citizens everywhere we go. But I think the I think that's largely changed. I think the idea, but I think what's missing from I would like to see more moderates, more of the moderate voice, but the moderate voice doesn't get the bandwidth like the negative or the impact. The impact crowd gets far more bandwidth. It's far easier to get publicity when you're making bold claims or bold statements about.
I try to be respectful of the different vantage points, because I do think, and sorry, there's a little construction going on, so if you can hear it,
it's okay.
I think there's people out there who feel a genuine sense of urgency, and I think that given some of the things we're seeing, and the fact that I'm going to be probably dead, if not long dead, before we see the maximum impacts of our lifestyles on the planet and such. I think the people who are inheriting the planet are generally the loudest voices, because they're the ones going, "Wow, my inheritance is looking more terrible every day because I'm inheriting a dirty planet." So, and an overcrowded planet. So I get why there's people who are going, "This can't wait. Like we have to really approach this in a genuine, concerted fashion." Again, trying to temper that with the idea that we have not gotten there yet with a lot of the technology that's required to run this planet and these 7, 8, 9 billion people on it, so that we can all have live a similar lifestyle to how we live today, populate areas that are colder and heat our houses, feed our family, those types of things. So I think we're at a serious inflection point right now.
Right.
And again, it's one of these things where it'll be I'm not smart enough to solve this problem. I'm very interested to hear or to see what the people who are smart enough to solve this problem do to conquer it, because we're a pretty smart species, humans, and I would think that we will find a way to resolve this problem, hopefully before too long.
Yeah, I don't think any of us wants to live in a Mad Max world.
Well, the movies were pretty awesome, I'm not gonna lie.
For sure. Is it a coincidence that there seems to be dozens and dozens of dystopian thrillers, movies coming out these days, which show, either a post-pandemic world or a post-Armageddon world. It's so, and I guess sometimes it feels like the world is moving in that direction. And I'm curious to know your thoughts, since we're on the subject. Why do you think it is that advisors, in general, I don't want to lump in everybody, obviously, but on average, let's say, advisors seem to be pretty ambivalent about ESG?
I think there probably hasn't done enough communication from the manufacturers, from the screening tool manufacturers, to properly educate on what's being done, how it's benefiting the client, how it's benefiting the advisor, and how they build their business. All of these types of things, it kind of feels like since COVID has occurred, it's been, the products have proliferated to the point of almost feeling a little maybe foisted on advisors, and their clients are asking, and I think there may be a bit of a disconnect. And I imagine it's similar to when ETFs, alternatives, mutual funds, all of these new sort of products or investment approaches came about. Advisors probably need a little time to create a story that worked for them and their clients and their business on how to talk about the advantages, talk about why they're introducing their clients to these new investment approaches. So if I was an advisor, I'd be looking for more communication, for more discussion points. We used to create these things, let's say infographics, and we'd call them point and grunt. The advisor could sit with a client and sort of say, this is why I'm recommending this. This is what I expect to happen. This is how it's helping you build your future. All of those types of things. This is how it fits in with your larger portfolio. Again, COVID maybe put people sort of, restricted their ability to be out there telling those stories.
Yeah.
Whether it's on the manufacturer side to the advisor, the client side. But I feel like maybe there's advisors out there who know that they have to tell this story and maybe don't have the story as fully rounded as they might have with other stories in the past, where a wholesaler could come in and sit with them and say, here's from A to Z, this is what you need to know. This is what you need to tell your client. And this is how you can round out the narrative. Maybe the work wasn't done because people weren't able to sit together, and it's harder doing it via Zoom. Right. So I think that might be why advisors haven't fully embraced it. And there may even be a historic sort of hesitation based on that. Doesn't really contribute to performance. And again, advisors are judged by their clients. Of course, every client wants to say, I want my investments, I want my portfolio to echo my values. It's a whole other thing when they say, but it's down 15% last year. Yeah. Why is it down 15%? And the advisor has to, it's not as easy for the advisor to say, well, you told me you wanted all ESG, right?
That's right.
You wanted all your holdings to have an ESG overlay. So I think you get a bit of that. There is a bit of a disconnect. So that's why I think it's hard for advisors to tell that story. And I think it's going to get harder with markets as volatile as they have been over the past.
Yeah, exactly. And that's a great segue.